This morning on BRN, part two in our discussion about where core bond and core bond plus funds fit into a portfolio. And we're going to welcome back to the program Matt Brill. He is the head of U.S. grade investment credit for Invesco. Matt, welcome back to the program. Great to see you this morning.
Good to be back. Thanks.
So in the first episode, we talked about what is core bond and core bond plus. So my question to you is, where does those strategies fit into the institution or the retail investors' retirement and long-term strategy?
Yeah, so fixed income is really generally appropriate for retirement for two reasons, for retirement accounts for two reasons. One is the income you get. A lot of retirees are looking for consistent income. By definition, that's what fixed income is. The second is the diversification away from equities, or just really the protection of principal. So, equities give you more upside over the longer term, but in traditionally fixed income is there to be sort of the ballast of your portfolio. So that's what we're trying to do within our portfolios. That's what we think, that most investors are looking for out of fixed income is the surety of income, as well as that consistency of income and avoiding the volatility that you get in other areas of the market.
And income, certainly an important topic that we are covering in the retirement industry. Does it have to be an either or for core bond and core bond plus in an investment menu or in a portfolio? Like, do you have to just choose one, or can you choose both, or none at all?
Yeah, so I get asked this question a lot, almost as like, which one is your favorite child? So that's always the way we have to think about it. And I don't really like to answer that way. I think they both are appropriate for retirees' portfolios, and you have to think about what your risk tolerance is, though. So core, in my opinion, is the lower risk. It's designed to be lower risk. It doesn't have high yield. It doesn't have emerging markets. It's supposed to be higher quality. It's supposed to be a little more stable. However, it gives you generally less yield to go with it. So, that's the sacrifice. You take on a little bit more risk with Core Plus, and generally you get more yield. And over the long term, you generally will get, more returns if everybody does their job right, and if there are, not defaults and things like that. So it's kind of a, which one do you like? However, for your portfolio, it's totally okay to have both of them in there. And you maybe say, look, I think we're going to be in a recession near term. I want to own more core. If you think we're not going to be in a recession, you might want to own more core plus. However, it's certainly appropriate to own both of them. And it actually, we see a lot of clients all the time that maybe even split them down the middle and kind of view it as they're both income sources and they're just a different way of getting there.
A lot of the people watching on the program today are maybe intermediaries. They may be working with an intermediary. Are there any tips to performing due diligence as a fiduciary? If you're a fiduciary for a retirement program, or for an individual, or for a high net worth organization, are there tips to doing that due diligence between core and core bond plus, or the things you should be looking at?
Yeah, so I think the first thing you want to look at is really, how does this bond fund act? Does it look and act like a bond fund? And what I mean by that is, does it have duration in it? Do you want duration? Duration often can be a hedge to volatility. It can be a flight to quality trade. So what kind of duration does it have? How have managers done in the past during periods of recession? How have managers done in the past in a Fed cutting cycle? You also want to know how managers have done in the past if interest rates went higher. So all those things are what due diligence efforts should focus on. But what I mean by that is, in terms of, is it acting like a bond fund? Why did you buy bonds in the first place? We just talked about, you generally want income, you want diversification away from equities. So if it looks and acts like equities but doesn't give you the upside of equities, that's usually not a great place to be. So when we construct a portfolio, we're trying to give you that diversification away from equities, give you that income, and really look and act like a bond fund, because that's what you wanted to sign up for. You choose your own adventure in this world sometimes, and you want it to actually play out like the path that you invested on and expected to have happen with your portfolio.
And when it comes to that core bond plus, is there latitude for the manager? And should you, as an investor, institutional, retail, be aware that, when I was in the retirement industry, style drift was how we referred to that. So is there various types of latitude that may be part of a core bond plus portfolio?
Sure. So when you think about latitude, the biggest question would be, how much high yield is that fund manager allowed to have? How much emerging markets exposure is that fund manager allowed to have? How much investment grade is that fund manager required to have? meaning do they have to own a certain amount of treasuries or agencies to kind of give you that really true core to the portfolio rather than just mainly the plus. So overall, those are the key things you're going to want to look at. What are in the documents, but then also how has the manager used that in the past? And so we try to figure out where the economy is going, but we want to do well in all different market types. And so, you're going to generally try to look for an investment manager that has done well in a period of recession, but also done well in a period of expansion. And if you're only doing well when high yield does well, then you sort of have a style drift, as you referenced. And I generally think most investors don't want that style drift. It's maybe okay if it's a smaller portion of the portfolio, but if this is the main portion of their fixed income, they might want to know for sure that there's not going to be a style drift. Because again, it goes back to that expectation, what you signed up for when you went to go buy that portfolio or buy that bond fund. So that's the path that we try to stick on. We have certain limitations on EM and high yield in our core fund, as well as our core plus fund, what's allowed to be owned there, very tight measures from a risk management standpoint. But then also as a portfolio manager is utilizing that, not getting to the limits at all times. Other times when you don't think there's opportunities, you want to own less. So, latitude is generally good, but you want to have some constraints on how much latitude a portfolio manager has.
And to that end, and I think we're doing this on this program today, education really important for any type of investor. What should plan sponsors, and those are people that are sponsoring retirement programs, what should they do in terms of educating their employees and their participants about these two important asset classes?
Yeah, so the first thing is to know that not all bonds are created equal. Not all bond funds are equal. So that's a key part of just understanding there are some that have more risk than others. So if you know what the style is of the portfolio manager and they act in that style, that's good. But if they're acting different than that, then that's very bad. Because at least if you know that you're expected to take on additional risk, you want to be ahead of that and aware of that. But I think when you're an individual investor, you just simply want to have a general idea of the income you're getting and then what the expectations are on returns. You have to be realistic on what are expectations out of bonds funds. Bond funds are supposed to be the more secure, the less risky part of the portfolio. So don't come to the bond fund to be the conversation talk at your cocktail party. Generally, that's not going to be the place to be. This is not something you're going to be bragging about, but if things really go wrong in the world and you hit a recession, you want to at least be able to say, hey, I owned some bonds. It gave me some income and it actually helped protect me against that equity volatility. Maybe now I'll go sell my bonds to buy more equities. That might be a good time to do it. But if you don't have them in the first place, you may not be able to reallocate your portfolio when the market has trouble, which it will at some point, and you got to keep your cool head overall. So educating people to keep a cool head and knowing what they own is always very important.
Yeah, well said. Matt, we're going to have to leave it there. So great to see you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Yeah, thanks, Jeff.
And don't forget to subscribe to our daily newsletter, The Morning Pulse. Details at our website. Until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving. And don't forget, roll with the changes.